In this video, I'm going to break down what gaps actually are, why the market creates them, and what they tell us about buyers and sellers. And most importantly, how I use them in my zone flow strategy to find high probability setups. Okay, let's get into it. So first, what exactly is a gap? Okay, so a gap occurs when price moves from one area to another without much trading taking place between those prices. Okay, so say gold is at 3400, okay, and aggressive buyer step in and price instantly jumps to 3405, which means there is minimal two-sided trading in between, which equals a gap. Okay, so a gap represents an area where price moved very quickly with relatively little two-sided trading compared to surrounding price action. It does not mean there was zero trades in the opposing direction. So say it's a bullish gap, that doesn't mean there was no sellers no sales took place within that bullish gap, okay, and vice versa. Same for the bearish gaps. It just means that the buyers or sellers showed that they were in charge, okay? Now, why does the market create gaps? Okay, so first, it's either aggressive buying or selling. Okay, so buyers consume available sell orders, which means price must move higher to find sellers, or vice versa. Sellers consume available buy orders, which means price must move lower to find buyers. Okay, so two is news events like CPI, NFP, FOMC. So interest rate decisions cause rapid repricing across the order book. Okay, so number three is liquidity. When opposing liquidity isn't immediately available, price travels rapidly through the empty zone. Okay, now four is large institutional orders. Big participants overwhelm resting liquidity, creating displacement in one direction, either bullish or bearish. Okay, now why would price come back to a gap? Why does price even come back to these gaps? Okay, so the market may return to trade through an area that had little two-sided activity, a rebalancing of price delivery. Okay, so say bullish was in charge and we had little sell activity within that gap, price may return and continue going up, and vice versa. So warning, gaps do not have to fill. This is a common misconception among traders. Okay, so basically gaps are created in the market all day long, constantly. There's constantly gaps created on every time frame of the market, and just because there's a gap created does not mean price has to come back to these gaps and do what we want it to do, which is reject off and continue going in our direction, whether that's up or down. Now, a gap is an area of interest, not a guaranteed trade. Okay, so once again, just because a gap is created does not mean there's going to be a guaranteed trade, which that's okay. That's okay. So again, so what makes a gap important? Okay, so A, strong displacement, a clear aggressive move, not a tiny sideways candle. The move itself must show conviction. Okay, so if the market is consolidating, which means the market is just moving sideways, we don't have any clear direction of going up or down. Okay, we are not trading. Okay, we're not trading if price is consolidating. We want to show clear signs of market structure to the downside or the upside. Okay, so break of structure, displacement, breaking important, high or low, consolidation, displacement, break, gap. Okay, so break of structure is very important, especially within my strategy. If there's no break of structure, we're not trading. So location, gap sitting around a meaningful supply and demand zone matters far more than a gap in a random area. Okay, so like I said, there's gaps always being created at all points in the market, and uh, we're only looking for key areas where the aggressive buying starts to happen or the aggressive selling starts to happen. Okay, so D is liquidity, which means price takes liquidity then displaces aggressively. Okay, so example is equal lows, sweep, bullish displacement, gap. Okay, now how to use gaps within the zone flow strategy, which is my strategy. So step one is we identify the trend of the market. So determine direction, bullish or bearish, before anything else. Okay, we need to know if we're going up or down to know if we're looking for buys or sells. Once again, if we're consolidating, moving sideways, we're not trading. Now, wait for a gap to be created is step 2. So let the market create a gap through aggressive displacement. Okay, we have the gap has to get created, and we have to be able to identify the trend. Okay, so step 3 is break of structure. Confirm with a new high, bullish, or new low, bearish. Okay, this has to happen. We have to create a new high or a new low for me to even think about taking a trade. Now, step 4 is zone reaction. Okay, wait for price to interact with your zone and show signs of an aggressive move away from it. Once again, this has to happen. If any candle comes into our zone and closes within our zone, or pushes straight through our zone, then we're not trading. We have to show clear signs of rejection out of our zone. So for a buy, bullish example, we want price to come down into our zone, reject out, and continue going up. For a bearish example, we want price to come up into our zone, reject out, and continue going down. Okay, so that has to happen as well. Step 5 is wait for our entry. Okay, so once step 4 happens, we get the reaction, which is the wick out and continue in the opposite direction. We need to wait for a break of candle. As soon as the candle gets broken, that is our entry. We enter as soon as the candle gets broken. Yeah. So to break it down, we wait for a trend, gap, break of structure, zone reaction, entry. That's it right there. It's a 5-step strategy. Each one has to happen before the previous one happens. If we can't identify the trend, then there's no point of even looking for a gap. If a gap doesn't created, we don't care about break of structure. If break of structure doesn't happen, we don't care about zone reaction. And we obviously can't entry if none of these happen. So a bullish example is demand zone. Price enters our zone, we get aggressive bullish rejection, okay, and we wait for our entry signal, which is break of candle, okay. Entry logic is wait for our price to show buyers in control and then look for a retracement into the zone for confirmation, okay. Bearish example is just the inverse of the bullish example. So supply zone, price enters our zone, aggressive bearish rejection, and we wait for our entry signal, which once again is break of candle. Entry logic is sellers step in aggressively, wait for a retracement into the zone for the bearish setup. Okay. Now, when not to trade a gap. When do we not trade a gap? Okay. Price is moving sideways. So like I said earlier, consolidation. If price is moving sideways, we are not trading. We need to show clear signs of bullish or bearish price action. So if there's no clear displacement, not trading. If there's no meaningful zone, which means we're not getting break of structure, we're consolidating, we're not trading. Okay. If there's no structure confirmation, no new high, no new low, no break of structure, we are not trading. If we're headed towards major opposing liquidity, we're not trading. We're waiting to see how price reacts. Okay. Now, chasing an extended move. We are not chasing an extended move. Okay. So if we miss our entry and we're trying to get in late, that's not a good idea. You will lose if you do that. Okay. Now remember, the gap itself isn't the setup. The context around the gap is a setup. So once again, just because a gap is created does not mean that you're gonna get a entry. You're not gonna that a trade is going to basically happen. Okay. The context is very important. Each step has to align before entering a trade. Now, common gap trading mistakes. Okay, so mistake 1 is every gap fills. So like I've been saying, gaps can remain unfilled indefinitely. Treat fill as a possibility, not a prophecy. Okay, it's not going to for sure get filled. Just because there's a gap created does not mean that we are going to push back to it and reject off of it. Okay, in fact, a lot of the times there's gaps created and we just push all the way up, just keep going. Gap gets created, we just keep going up, or vice versa. A gap gets created, we just keep going down. Price doesn't always come back and reject off of it, which is fine. Okay, now mistake number 2 is trading every gap. What it does is turns an informational tool into a random entry signal. Selectivity is the edge. Okay, so our things need to align for us to even trade the gap. Just because there's a gap created does not mean that there's a trade opportunity. Okay, so mistake number 3 is ignoring structure. A gap without context is insufficient. Okay, structure gives the gap meaning. This is very important. Okay, just because there's a gap created, doesn't mean there's going to be a trade. Okay, we need to show important signs of bullish or bearish break of structure. We want to show signs of structure break. Okay, new highs and new lows. Okay, now chasing displacement. Don't chase the big move, wait for the setup. Retracement into the imbalance. Okay, so we just because there's a gap created to the upside doesn't mean we want to just hop in buys. Okay, because it's showing signs of bullish price action. We want to wait for price to come back into our zone and reject, and same thing for bearish. Now, mistake 5 is ignoring higher time frame. Okay, so a 1-minute gap inside a major higher time frame bearish area does not mean buy. Always align with the higher time frame context. So, for example, let's say we have a gap created on the 1-minute or the 5-minute, okay? And let's say that gap is a bullish gap, okay? But we go to the hour and price action is looking very bullish on the hour, okay? That might be signs that we might not want to hop in that 1 or 5-minute buy because the hour is showing that we're going to go down, okay? So just pay attention to that before entering your trade. Now, quick reference summary. So key points is a gap equals fast move with little two-sided trading. So a fast move up or a fast move down. Fast move up means there is little sales happening. Fast move down means there is little buys happening, okay? These are caused by aggression, news, thin liquidity, or size. A gap is evidence, not a signal. Just because there's a gap that is created does not mean we need to get into a trade, okay? Gaps do not have to fill once again. Just because there's a gap created does not mean we have to come fill the gap and reject off, okay? What matters is displacement, structure break, location, and liquidity, okay? So gap, break of structure, zone, rejection, entry. Straight like that. We want to wait for a retracement. Do not chase the move. Do not chase the move. We never want to chase. Context around the gap is the setup. Once again. Now, decision tree. So basically, our entry confirmation signals what has to happen for us to enter a trade. So number 1 is, are we trading with the trend? If no, we skip. We don't trade. If yes, okay, continue. Wait for the next step, which is number 2. Is there a gap created? If no, we skip the trade. If yes, we continue, wait for the third step. Did we break structure? / is there a new high or low created? If no, we skip the trade. If yes, we continue on to the fourth step. Fourth step is there strong rejection out of the zone? If no, we skip the trade. If yes, we continue to the fifth step. Did any candle close in our zone? If no, we skip. If yes, we continue. No, this is wrong. This is opposite. Did any candle close in our zone? If yes, we skip. If not, we continue. Remember, we don't want any candles to close in our zone. We want it to reject out. Now, 6, did we get break of candle? Okay, did we get break of candle? If not, we skip the trade. If yes, we watch for the entry trigger, which is break of candle. If we get break of candle, that is exactly where we enter our trade, place our stop loss and CP, and move on from there. So the story matters more than the zone. So trend, gap, break of structure, pull back to the zone, rejection, entry. This is gold right here. This is the complete strategy, okay? This is the complete strategy. This is all we are looking for. It's an easy 5-step strategy. We are waiting for the trend, okay? Are we bullish or bearish? Okay, once we figure that out, we wait for a gap to be created. The gap has to break structure, okay? So once we get break of structure and a gap, that's check, 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 okay? We wait for price to pull back to our zone, reject out of our zone, and we enter off break of candle. It's that simple, okay? So now you should have a pretty good summary of pretty much what a gap is, why they're created, and how we use them to trade, okay? So with that being said, let's hop on the charts and let's show some examples of what this actually looks like, okay? So right here we have an example of a bullish gap, okay? Now the way I like to explain this is we have a 1, a 2, and the 3, okay? Now the 1 in a bullish gap will always be to the left of the 2, okay? And the 2 will always be bullish, okay? This is where the gap gets created. This is where the buyers take control, is the 2, okay? Now the 3 will always be to the right of the 2. Doesn't matter if the 3 is red or green candle, bullish or sales, okay? But the 1 has to be bearish for a bullish gap, okay? Now, where exactly is the gap? What does it look like? The gap will always be between the 1 and the 3, okay? The gap will be between the 1 and the 3. That's where the gap actually is. That's where the gap actually is, okay? Between the 1 and the 3. As you can see, we have no buyers or sellers in this area, okay? We push straight through this area. So this is where the gap actually is, between the 1 and the 3. Now, in a bullish gap, we are just waiting for price to, push up, create the gap, whoop-de-doo, push down into our gap area and show rejection out to the upside, okay? So we would have a candle come into our zone, reject out, okay? And then we wait for break of candle to enter our trade and continue going up. Now, bearish gap is, just the same thing, but for sales, okay? Now, in a bearish example, make sure you're paying attention, writing this stuff down. If you need to, go back and rewatch and, listen to what I'm saying, okay? Now, a bearish gap, the 1, 2, and 3, okay? In a bearish gap, the 1 has to be a bullish candle, bullish or green candle. The 1 always has to be bullish or green. The 1 will also be on the left side of the 2 in a bullish gap. And, the 3 doesn't matter. The 2 will always be a selling candle, selling or red candle. The 2 will be in a bearish gap, okay? Once again, the gap is between the 1 and the 3, okay? This is where the gap actually is, okay? So we're showing signs of strong bearish movement. Boom. We wait for price to come back into our zone area, our gap, and we want it to reject out. Now, we always draw our zone around the 1 candle, okay? So for bearish, the zone gets drawn around the 1, just like that, okay? And we wait for price to come back into our zone, reject out, entry off break a candle to grab the sales, okay? And it's the same thing for the buys, okay? We draw our zone around the 1 candle, just like this. We wait for price to come back down into our zone, reject out, wick out of our zone, and enter off break of candle to grab the buys, okay? Now let's see what this looks like on the real charts. Now we should have a pretty good idea, about how to spot gaps, and stuff like that, how to spot the right gaps, okay? So right here we have a bearish example of what a gap is, okay? So this would be the 1, this bullish candle, this green candle right here would be the 1, or no, right here. This bullish candle right here would be the 1, this red selling candle would be the 2, and then this would be the 3. This is obviously a bearish gap. Like I said earlier, the 2, which is this candle, has to be a selling, and we're obviously going down, okay? So the trend, obviously, we are going down, okay? So we're looking for sales, okay? We then get our gap created, okay? We get our gap created, and we break lows here. We break these lows right here, okay? Check, check. Now we draw our zone like this around the 1, okay? And we wait for price to come back into our zone, reject out, and then we would be entering off break of candle, which would be right here. Stop loss goes above the wick of the candle that gets broken, okay? And, you place TP from there. You can go for a 1-to-1. You can go for a 1-to-2, whatever. Now, let's see a bullish example, okay? So right here we have a bullish example. This red bearish candle would be the 1. This 2 bullish candle would be the 2. And then the 3 right here, 3's right here, okay? Now, we get our gap created, and we get break of structure here. We break these highs, okay? So, boom, gap, break the highs. We draw our zone around the 1, just like this. And what do? Wait for price to come back into our zone, reject out as it does, and we would enter in for longs on break of candle, just like this. Stop loss goes below the wick for buys. Stop loss goes below, and then we can go for a 1-to-1, 1-to-2, whatever. And boom, so that's a bearish and bullish live examples of the strategy, okay? And that pretty much concludes, this gap masterclass, okay? I showed you, why gaps get created, why not to trade a gaps, what's the difference between a valid gap and a non-valid gap, and pretty much everything you need to know about gaps. So that's going to conclude the video. I hope you were able to learn something from this video. I hope are able to identify gaps now in the market and the correct gaps. I hope you can, learn the strategy and trade it. Thanks for watching. I have a free Discord. It's going to be linked in my bio. You can come check it out. It's all free. I trade live for free, give all my information out for free. Thanks for watching. Peace.